Well, Friday's core PCE print certainly put a bit of a cat amongst the pigeons, not only coming in significantly hotter than expectations, but also showing a surprise re-acceleration in inflation in January. That saw dollar bulls remain firmly in the G10FX driving seat as the market continued its hawkish Fed repricing, with the terminal rate expectation now sitting north of 5.5%, and another chunky bout of selling coming in across the Treasury curve, which of course pressured risk assets, with the S&P 500 and NASDAQ both notching their worst weeks since last December. A little bit of a quieter docket awaits this week, a handful of PMI figures and a boatload of central bank speakers on deck, leaving us plenty to discuss in this week's Trade Off UK with Ryan Littlestone. So without further ado, let's get into it. Well, as I said, we've got a busy show this week from what I think Mr. Weston described as a dull and grey London last week. I've just about recovered from those remarks, having spent most of the weekend crying into a pillow at Chateau Brown. As I said, plenty to discuss in the markets this week. Ryan Littlestone from Forex Flow Live and Forex Analytics is with me as always. Ryan, good morning. How are you doing?
Good morning, Michael. Sun is shining here, as it often does in the UK. You know, you do get it now and again. You know, and if we see it, we obviously take a photo to put on the wall. So it never lasts for long. But
Exactly.
Yeah, it's all right when you're living in a desert and you're living down under and you get sun 24/7. So yeah.
I was going to say, we'd rather have it this way. We can cherish the sun when it does pop up, and hopefully those rumours of snow a little bit later on this week don't come to fruition. I know we want to talk about the UK in our first segment of the show, so let's move away from the weather and onto the markets in Topical Thunder. So the UK, we had some good data last week. I'm probably one of the most pessimistic analysts out there most of the time, but I want to try and dispel some of the doom and gloom in our first segment today. The PMI figures that we had out of the UK last week were very, very strong indeed. The services sector expanding at its fastest pace in 8 months. The manufacturing index, yes, it's still in contraction, but it's a 7-month high on that manufacturing PMI number. And also some other survey data coming in pretty strong as well. Barclays had a survey out of SMEs in the UK, and 55% of those SMEs surveyed are expecting a year-on-year revenue increase in the second quarter of this year. So all of a sudden, we've gone from doom and gloom, the end is nigh, the UK is going to have a 4 or 5 quarter recession, to everyone going, actually, things might not be quite so bad. You've seen a pretty dramatic repricing of rate expectations here in the UK. And I think this leaves the Bank of England in a bit of a pickle, because we had it anticipated, and their commentary had pointed towards the hiking cycle coming to an end in March. Well, now, all of a sudden, after this data, the market is pricing in hikes all the way through until August, and a terminal rate of 4.75%. And you've just got a really messy picture here in the UK. Survey data is improving. Inflation figures are surprising, better than expected, cooler than expected. And you've still got that possibility of a 4-way split on the MPC next month. You've got Temrero talking about rate cuts, and you've got Catherine Mann, another external member on the MPC, as hawkish as she's ever been. But what's interesting to me, Ryan, and I'm keen to get your view on this, is that cable hasn't really reacted too much to this. Euro sterling hasn't really reacted too much to the good news either. Cable closed below the 200-day moving average on Friday. Euro sterling has ticked higher for 3 or 4 days now. Why do you think the market is just shrugging all of this off?
I don't think it's so much shrugging it off. I think, as we saw with last year, it's all about the Fed. If the Fed is moving, if the market is trading what the Fed's going to do, higher rates, longer rates, whatever, dollar is becoming supreme once again. And this is one of the things I said at the beginning of the year. We perhaps need to look at the crosses more than cable, pound straight to the dollar. Because the BOE could hike to 5.5%, and you probably find that cable doesn't go up that much anyway, outside of a knee jerk. You will notice, though, we're getting close in expectations to my magic 5% number, which I still think the Bank of England is going to be forced to go to. We're going to have this disagreement, I know.
I still think it's punchy.
But yeah, the MPC, as you say, we've had both ends of the scale last week. Man on one side, Temrero on the other side, and a whole big mess in between. So it's going to be interesting the next meeting. But I just don't know this data. It's all coming really quickly, a positive uptick, and I've got a half a hunch that it's just some New Year bounce, but we won't know until we get the rest of the data.
No, exactly that. I mean, as they say, I think I tweeted this out last week, one swallow doesn't make a summer. One round of PMI surveys certainly doesn't mean that all is fine and dandy again, but it does run against the kind of prevailing wind, which is that the UK is doomed. So it's good to see some decent UK data and sentiment improving a little bit. But let's have a look at data more broadly, because I know you wanted to discuss the divergence that we're seeing going on a sector level.
Yeah, and this is something we saw a couple of years ago, where we just see a divergence in the data. I mean, if you look at the PMIs, take those straightforward. We've got the services side and the manufacturing side. The manufacturing data, pretty much in all the PMIs, some improved, but they all still remained mainly in contraction. Yet it was the services side that we saw, really jumping in a lot of countries. So there's a bit of a sector divergence going on, and say something we've seen in previous years. And it's got me thinking, as just mentioned, maybe we are just seeing a bit of a New Year's bounce, because if you look at the January retail sales from around the world, they were all pretty much improved in January. We got a really lousy November, December, usually the strong retail months. Then everywhere in January saw a rebound, and you've got to be thinking, well, where's that come from? Everyone was skint November, December, and now all of a sudden they're flush. So maybe these PMIs are reflective in the services part, that the data may be getting better, but it's leading from that retail sales, more people going out, using leisure facilities, that sort of thing, everything that goes into that services index. And the February numbers are maybe pointing to a bit of that. So it's going to be interesting to see the next set of numbers coming through. Obviously, one of the big pieces is the non-farm payrolls, which isn't this week for once. Yes. It's next week on the 10th of March. We obviously got that gangbusters January reading in the 500,000s. Are we going to see similar, or are we going to see a bit of a washout coming in? So when you're looking at the fundamentals and trading the fundamentals, all these rate hike expectations, it needs to be backed up by the data. And as you say, 1 month's data isn't going to cut it. So if we start seeing a series of better data, well, then everywhere's looking at soft landings or no landings. And then we're going to be trading around the rate expectations again, matching those off against the US, matching them off against other countries versus other countries, hence why the crosses are going to be important. So, yeah, we need more evidence. I'm sounding like a central banker now. We need more data.
It's almost like Lagarde has joined me, just minus the fake tan and the Hermes scarf. I do think you're right, though, and I think it's an interesting point. And actually, if you think slightly longer term, it does lead me to question the longevity of the improvement that we're seeing. If so much of the growth and resilience in the economy that's coming through is being powered by services, it is being powered by the consumer. If we do start to see the labour market soften off, and in the environment we're in, I question how long unemployment can stay below 4% in most of the developed world. If we do start to see the labour market come off, if we do start to see consumer sentiment sour, the cost of living crisis continue, then people are naturally going to tighten their belts. That services spending will come lower. And as you say, it could just be a very kind of short-term bounce, which then leads to perhaps more pain further down the line. I mean, I think something that a lot of macro commentators are already talking about is, yes, we may get this no landing outcome now, but does that make things worse further down the line, because the economy has to deal with 5.5% rates in the States at least for much, much longer than it otherwise would have done? And I think that brings me quite nicely on to my point about core PCE and the inflation figures that we got out of the US on Friday, because they were much hotter than expected, 4.7% year on year. The expectation was 4.3, and the December print came in at 4.4. So not only is this a nasty surprise in terms of coming in above where we expected it to, but it's also a nasty surprise because it shows that after 4 months of trending lower, we're starting to see prices move higher again. But actually, perhaps it shouldn't have been too much of a shock, because the January CPI print was hot, the January PPI print was hot, so it kind of follows on from that. But I think this is much more impactful, because we all know the core PCE gauge is what the Fed look at, and that is their preferred inflationary figure. So I do think it's just a sign that, and I know this is something that you've been talking about for quite some time now, that markets have perhaps got a little bit complacent about inflation coming down in a nice, orderly manner, and we're going to be back at 2% before we know it, and we can all put our feet up and have a nice cold beer and stop worrying about it. And I think that's why we saw such a violent reaction last week. As I said, the equity market, the S&P 500, having its worst week since the 9th of December, the bears firmly wrestling control of things there. The 2-year Treasury up about 20 basis points on the week. The 10-year yield into 4% for the first time in quite some time since the third quarter of last year. So I think this might just give markets perhaps a little bit of a reality check to say, you know, all is not necessarily okay. You know, higher for longer is slowly but surely sinking in. And I think there could be more downside to run in the equity market as the market continues to not only digest the data, but also what it means in terms of the Fed outlook, particularly with the next FOMC not 3-4 weeks away still.
Yeah, definitely. I mean, that PC number, again, another pulling one out the hat. You know, everyone was expecting maybe from the CPI, yeah, it didn't fall as much as expected, but it was still lower, you know, 7th, 8th month on the trot lower. And then PCE sort of blew that out of the water by going much higher than it was even previously. So it has caught people on the hop again, but we were already trading that way, as we know. We're trading a more hawkish Fed. And you're right, I said the inflation, it's not going to be a one-way street. It's where prices settle that's going to be important. And for now, it looks like the trajectory of inflation is slowing up and not coming down as fast as many expected. But I've got to wonder, you know, with markets, you know, okay, if we maybe priced, you know, a ceiling was 5 to 5.5% previously, maybe it goes 5.25 to 6% now. You're only talking maybe 25, 50 pips change on that. You know, is that really going to send yields up to, you know, 4.5%, even, you know, higher for longer? Is the dollar really going to shoot up that much on such a small increment, if you like, in expectation? So I think there's twofold situation that we're trading here. One, the market not really pricing the hikes properly the first time around, and now they're playing a bit of catch up. Then you've got to wonder how far more have we got to go? You know, maybe 10's up to 4%, and that's round about the level they halt at, because once rates get up, remember, we need to start trading coming back to whatever neutral rates levels the central banks decide to set.
Yeah, exactly that. We'll hold that thought, because I'm going to get onto Fed pricing and bonds in a short while. But before we do, we've got, you want to talk about something very important, which I would argue doesn't get enough attention in trading and in the market.
Yeah, definitely. I know, you know, we like to talk about the fundamentals and prices, but I think it's important for traders sometimes just to, particularly in these types of shows, just to touch on trading habits, trading psychology, because I think that's very important. And this is coming up from a couple of questions I got asked this week or last week. Just regarding trading, when I enter trades, you know, a lot of people say, well, what's your profit target? You know, where are you looking to get out? And I always say the same thing. When I go to enter a trade, profits aren't important. I don't care about targets. This is the last thing I look at when trading. The first thing I look at when trading is getting my risk to zero as soon as possible. That is it. From the moment I enter a trade, I want to get my risk down. And however I need to do that, I'll do that. You know, if you look at a trade, say you're doing a quick scalp or something, so you buy something with a 20 pip stop. If I get 20 pips up pretty quickly, I half the trade. Okay, that way the trade is at zero. My risk is zero. I made 20 pips on half. The worst that happens is I lose 20 pips on the other half. It's a zero-sum game. So instantly I'm at zero. And what that does psychologically is it takes the pressure off. I'm not worrying about, am I going to lose? Am I going to lose? Am I going to lose? I can sit back and let the trade do what it wants. And if it carries on going, I can bring my stops up behind it. But many traders focus on targets. They jump into a trade. I'm going to trade this with a 30 pip stop. My target's 200 pips, the 200 DMA, 200 pips away or something. Well, you may not get there. So what are you going to do if you don't get there? So plan your risk first. Always manage your risk first. Get your trade to zero. We're all here to protect our accounts. We're here to make money. Yeah, we are here to make profit, obviously. But the fundamental thing we have to do first is not lose. If we don't lose, then everything else is a bonus, and we're pretty much guaranteed to make profits because that's the only thing that can happen. So getting your trade risk to zero fast as possible allows your trade to breathe, and then you can really try and run the trade. And if you might get your 200 pips profit, okay, why need to take it all off? Take a little bit more off, move your stops up behind. Maybe you get 300 pips profit, but the pressure's off. You're not going to lose on trade. And I think traders need to imprint this in their trading heads.
Yeah, no, I think that's really important. And you know, the first priority should be protecting your account, managing your risk. And I know we sit here and you know, every week and we say, you know, we expect euro dollar's going to go to 105 or cable's going to go to 118 or whatever. That's because we're putting actionable ideas out for people to mull over and to think about. But as you say, you know, the key priority has to be limiting that risk as much as you can. Because, you know, the biggest risk any trader runs is risk of ruin. And that is also the biggest risk and the easiest risk to eliminate. And all it takes is thinking a little bit more cleverly about things in order to do that. And I think it's a really important point that I'm sure we will continue to tap into as the show progresses. But having mentioned actionable trade ideas, and let's get on to some charts. Well, as the police siren stops, we can bring up the charts. Let's have a look at Fed pricing first. Now, this is a rather colourful chart. If anyone out there has a Bloomberg terminal, eCan Go is the best thing Bloomberg have ever done, I think, because it allows you to create fancy graphics like this in about 10 seconds. So what are we looking at here? Well, what we're looking at is the Fed funds rate. So that the white line is the Fed funds rate going back to 2017, 2018, whenever it is on the x-axis there. And then the colourful lines is really what we want to focus on, because this shows the market implied path where rates markets and futures contracts expects the Fed funds rate to be between now and 12 months out in the future. So this goes out until February of 2024. And the dates I've chosen there, they've not been chosen at random. We've got the orange line, which is the February FOMC. We've then got the January non-farm payrolls print in blue. We've got the January CPI print in pinky purple. And then the green line is Friday. So that when we got the January PCE number. And the reason I want to show this is twofold. One is because it just shows how dramatic the repricing has been. The terminal rate has gone from being priced at just over 5% on the 1st of Feb when we had the last FOMC to now sitting at about 5.6% after the PCE number on Friday. So a 25 bit price is now hike is now priced for March, May, and for June. The other important thing about this chart is that it shows how markets are not only pricing the higher bit, but they're also pricing the for longer part, because having gone from pricing about 60 basis points worth of cuts at the start of the year, the market now prices in just 12 basis points worth of cuts by year end, which is basically nothing, as near as makes no difference. And I think this is important because when you look at this chart, what it says to me is that actually the market, according to what the Fed have been saying in their speeches, according to the dot plot, the market has now pretty much priced in those themes very, very well. We've got higher priced, we've got for longer priced in. So it just makes me start to think that the moves we've seen on the back of this, and Ryan, this is a point you touched on earlier, Treasury selling off pretty violently across the curve, the dollar rallying for 4 weeks in a row, and equities taking some pretty significant moves to the downside. It just makes me think that those themes may now have run their course, and we may be due a little bit of a pause or even a reversal in some of those dramatic moves that we've seen over the last 3 or 4 weeks.
Yeah, it's markets in a nutshell. You know, we talk about pricing, repricing. The market's having its reprice period. I'm surprised it's gone on for as long as it has. So I'll be even more surprised if it continues and we see higher levels in yields, much higher levels in the dollar. But you're right, the market is getting on board with Fed hikes, and what will happen is it will make these moves in repricing. Then it's going to wait for all the Fed heads to start speaking again. It's going to want to get to the next FOMC to find out, okay, are our actions justified? You know, is the dots going to start heading higher? even people like Bullard, really haven't changed their tune. He sees the midpoint of the Fed fund futures at 5.375%. So that's bang in the middle of the 525, 550 FFR level. So he hasn't taken his higher, but some of the other members have been speaking, maybe we're prepared to do more if need be. But it all needs that confirmation from his nibs, Powell.
Yes.
And if we get to the next FOMC meeting and the dots don't move higher, and Powell says, we're happy with the pace we're keeping at the moment and where rates are going, then we're probably going to see a top in yields, and the market does a little mini reprice because, as usual, as often, it tends to go a bit too far than it needs to go. So, yeah, it's going to be a case of seeing where the market wants to really settle at the moment when we get the next FOMC.
Definitely. Well, 7th of March is the date for the diary between now and the next FOMC, because Jay Powell will be delivering his Humphrey Hawkins testimony on Capitol Hill. So we'll surely dig into that next week. But what about euro dollar, your next chart?
Yeah, well, we sit around and we look at charts all day, and what I like to do is look for those really big levels, and the 105 level in euro dollar is a real big one. This one goes, all the way back to 2003. It's one of these levels where if we haven't visited for a while and we come back, then you pretty much guaranteed that it's going to have a say in the price action. Either it holds up for a while and then breaks, or it becomes a decent level of support and we move away again. I mean, the last time we were down here was, last year, middle of last year, where we came down from those highs, way up in the 120s. And it took about 3 weeks before we actually broke it, as you can see there in that sort of April, May period. And then when you do break it significantly, well, it's a big runner. So here we are again. We've been up to the 110s in the rally since September, October last year, and we're close to it now. And this is going to be a level I'm going to be looking to trade. It's a similar picture in a lot of dollar pairs. Similar picture in the Aussie dollar and in the Kiwi, coming towards this 38.2 fib level of that move from last year. So it's a good test for the trend. If the trend's going to hold, these are the sort of areas it needs to hold. So from a trading perspective, I'm looking at it for potential short-term long off the 105 level, just to see if it stands up again, stands the test, if you like. But if we do break it, then that tends to mean that there's something really maybe changing in the trend, and we're going to undo some of that move that we saw from last year. So big, strong level for me.
Yes, it's a huge level. And I think, the important thing is it's a level that the market has reacted to pretty much since the inception of the common currency. It's a psychological level around that big figure. And also you've got a handful of daily and weekly moving averages around that point as well. So I do think 105, 104, 90-ish, absolutely pivotal for the euro. Personally, from a fundamental side of things, I don't really see much reason to be buying the euro at the moment. I think the bullish narrative has pretty much run its course. But then again, let's see how price reacts as and when we get to this level. And of course, that must rule our decision making. But speaking of that, the FTSE is at an interesting level as well. Obviously, we had this barnstorming rally in the FTSE 100 from kind of late October all the way through until early February. Now, you've got to remember the FTSE 100, it's not a great index when it comes to the composition of it. And also the vast majority of the revenues in the index come from overseas, which is why the decline in the pound and the significant softening in cable has helped the FTSE have this great run. But we started to take a bit of a pause for breath. We hit that new all-time high, just above 8,000. I think 80.20 was the level that we got to. And now we've come back to test what is quite an interesting level. It's not only the trend line that's been running things since last October, when the rally began, which we've tested 3 or 4 times since, but it's also the high that we reached in May 2018, which I think when we reached it was an all-time high in and of itself. So there's obviously 2 ways you can play this. Personally, given my bearish view on the pound and my cautiously bullish view on European, particularly UK equities, I think we'll probably get a bounce here and move back towards that all-time high that we saw previously. But if we do break below this level, then again, there's some relatively easy areas from which you can play this on the short side. You've got the 77.60 region, which is where the October 2018 high sits, and also the 50-day moving average. And then obviously you've got the pre-COVID high of your uber bearish, which proved very, very stiff resistance in the past. So I think the FTSE is in an interesting spot. And if we do get a closing break below this kind of 78, 90, 7900 region, then I think the bears might wrestle a bit of control of things in the short term.
Yeah, I think you're definitely right there. I think it's for some, it's probably going to be a bit disappointing to get back below that psychological 8,000 level. You want to see a break up there, and you want to see it holding, becoming really solid, so it can kick on a bit further. So the fact that it hasn't lasted too long above that level maybe sends a bit of caution into the trading. But I think that pre-COVID high, I think that's the doozy of the level. You can see from your chart there, we tried it several times as resistance, and then when it did break, off it went, and pretty much straight after became support. And technically that's what you want to see from a level. So I think you've got a bit of room to play, and as you say, your levels are good, but that 77 20 76 25 30 area, those recent highs, that's your make or break level. If we're back under there, then potentially we're heading all the way down.
Yeah, most certainly. I mean, I think disappointment has been synonymous with the FTSE for the last decade or so. So certainly don't rule out a move in that direction. What about dollar yen? Obviously, we heard from the new BOJ governor last week.
Yeah, and a bit of surprise. And this one's a bit of a follow-up from last week, because obviously it's a key pair with what's going on at the Bank of Japan.
I'm now such a fan of clouds and all the rest of it. We can see it.
I'm teaching now. See, you can say we've got plenty of clouds in this one to Chris when you next see it. But yeah, we had Ueda speaking in the Lower House, his first hearing, and it was really strange because the yen really didn't move at all. If I had to put my finger on it, pick a side, he was more Kuroda than anything new. He touched upon maybe we could exit, we have the tools potentially to do so, but he wasn't committal to anything. He said that current monetary policy is appropriate. Following a lot of the lines that Kuroda has. And I thought this might have rocketed higher, on that appearance, but it didn't. And it really took the US data and yields moving higher to get this move. But we were speaking about this area that I've highlighted in the chart in the circle there. It's a technical dream in terms of confluence. You've got the moving averages up there. You've got the top of the cloud up there. It's a prior support and resistance area. So if we're going to run in trouble, if the market's going to reprice the dollar, reprice yields, reprice the Fed, these are the key levels it's got to take out in pairs like dollar yen to confirm that. If we get up there and we can't get through that area, well, that's going to say the market's gone as far as it's going to go. That's a good area to think about shorting. And then maybe we get a pause. And if it's solid enough, then you should get a decent rejection, at least on the first instance to trade. But then it could build up into a longer term range, and maybe you get some decent movement back down towards the low 130s perhaps. But a big, strong technical level, we're inching up there. And as traders, these are the ones we look for.
Yeah, it's an absolutely huge level. And you're right. I think Ueda, whatever we're calling him, his appearance was quite interesting last week, because I think it's becoming increasingly clear that he was almost selected because he is going to be very, very close to what we saw from Kuroda in terms of monetary policy. The exit from YCC and this huge amount of bond purchases that the BOJ have been conducting is going to be gradual. It is going to be very, very slow. And I'm surprised that the yen didn't trade too soft in reaction to that. And it just makes me think that maybe the market's priced that in. Maybe the market is now pricing Kuroda Mark II. And actually, we need to look to the dollar side, and we need to look to where yields are going in order to gauge the next direction for dollar yen. So if we go back to what I was saying earlier about, the kind of bullish dollar, bearish treasuries narrative seems to maybe be running out of a little bit of steam. We're at this huge technical level as well. I wouldn't mind leaning against that and seeing a bit of downside in the short term. But let's get on to our actionable ideas of the week in our play of the day. So I'm going to take that idea that I just outlined and take it a bit of a step further, looking at the dollar index. As I've been saying throughout the show, I think the risk reward, that's easy for me to say, on long dollar positions is starting to look a lot less attractive now than it did at the start of the month. The 10-year has hit pretty much as near as makes no difference, 4%, and I can't really see us pushing significantly above that level. The Fed Fund futures curve is well priced, 25 pips in March, May, June, and pretty much nothing in terms of cuts priced in for the remainder of the year. So higher for longer, tick in that box. Corporate month end is pretty much out of the way as well, and that was obviously bullish for the dollar if you believe the bank models at least. And when you think about what could give the dollar another leg higher, well, what could it be? Another blowout labour market report, a hot CPI print? Do we really think that they're going to push the Fed into a 50 basis point hike in March? I don't think there's any way they go down to 25 in Feb and then back up to 50 in March. So I think that's pretty much off the table. This kind of 105.50 level has been a big level for the dollar index going all the way back to June of last year. Of course, remember, the dollar index has got a huge euro weight in it. So going back to what Ryan said earlier, I don't think we're going to see a massive rolling over in the greenback. But what I do think we're going to see is a bit of consolidation. So I'd be very surprised if we manage to get north of the 50 and the 200-day moving averages around 106. And I think we're probably going to get back into a range between about 103 and 106 for a short period of time. So I wouldn't mind leaning short here as we move into the bottom of that range once more. It just feels like the bullish dollar narrative has run out of steam a little bit, and the market is going to have to wait for a new catalyst and is likely to range while it does so. Ryan, what about you? Dollar CAD?
Yeah, dollar CAD, we are very much dollar specific at the moment because that is pretty much the only game in town in the main. And dollar CAD, again, a lot of these trades we're looking at, both yourself, is looking at finding the stretch points for this dollar move. We understand that the dollar is the path of least resistance, being long dollar. We understand that there could be more upside. But then when you're looking, if you're not in longs already and managing those trades, you're looking at what you can do elsewise. And, so for me, it's looking at, okay, where, just like you said, where will the price run into trouble? You had your levels on the Dixie there. My level for dollar CAD is up at this 136.90, 137, a former resistance area. So the techs are leading me on this one. If the price is going to break higher, if the dollar is going to move significantly more higher, these are the levels it's got to take out. And if it can't take them out, well, there's potentially a trade for you. So my trade this week at least is to short into that 36.90, 37 handle. You don't need to give it a lot of room, depending on how deep your pockets are, maybe 20, 25 pips. If you want to stretch it a bit further, you're really wrong above 37.50. Look for shorts into that. And if it pulls back, get some money off the table, lock in your stops and trade them down there under.
Good stuff. Well, that brings us to the end of another show. Thank you, as always, for watching. Thank you also to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me. And a big thanks to our producer, Kyriakos, for putting this all together for us on his day off, rather than sitting there with a beer on the beach, as he should be. Hope you've enjoyed the show. Drop us a comment below if you have any questions for us. And also, if there's anything you would like us to cover in the show next week. In the meantime, also check out Trade Off Australia, our sister but worse show, to see if Westy has any other insults to throw at me next week. And of course, we will be back with you again this time next week. Thanks as always for watching, and goodbye for now.